If you're like most day traders, you spend a lot of time scanning your screens for massive vertical moves. You're hunting for that giant green candle, hoping to catch a ride on pure momentum. But here's the reality of the market. By the time that giant surge actually appears on your screen, the institutions have already extracted their profit. If you're buying after the candle explodes, you are buying the exact moment the smart money is cashing out. If you want to catch a massive move from the very first pip, you have to stop looking for the biggest candles on the board. You need to hunt for the absolute smallest. Explosive market momentum doesn't begin with loud, chaotic price action. It is born out of total market silence. We call this silent phase the inside bar. While it looks like a boring period of indecision, this range is actually a collection point for orders, a warehouse for the market's stored energy. Think of the market in terms of physics. As the trading range narrows and prices stop swinging, buy and sell orders start piling up on both sides. The market is effectively coiling, compressing all those pending orders into a tiny space and building immense pressure. This setup functions as a volatility spring, a temporary equilibrium between buyers and sellers, where the tighter the compression, the sharper the eventual release. This chart shows how that coil visually forms on your screen. It always starts with a foundational candle we call the mother bar. This is the alpha candle. We draw boundaries extending outward from its absolute high and absolute low to set our trap. The inside bar is the consecutive candle that follows. For the setup to be valid, this second candle's entire high to low range must be completely swallowed by the mother bar's boundaries. It cannot pierce the high or the low. Occasionally, the market coils even tighter, creating a multi-inside bar or an II pattern. This happens when a third candle forms entirely inside the already restricted range of the second candle. The probability shifts here as time passes. The longer price stays trapped in this corridor, the more orders stack up just outside those boundaries. When the market finally breaks the range, that cluster of unexecuted orders provides the fuel for a rapid surge in price. Time spent in compression correlates directly to the breakout's velocity. The market relies on that trapped liquidity to propel price once the boundary is breached. But if you trade every inside bar you see, you will drain your account. Trading this pattern in a messy, horizontal market puts you in the meat grinder. Your stops will be hit repeatedly as the price chops back and forth without ever picking a true direction. To filter out that noise, this chart applies a 20-period exponential moving average, or EMA, a line that tracks the recent momentum of the price to separate real signals from chop.
High-probability inside bars act as brief rest stops during a strong existing trend. You want to find an inside bar resting gently right above a sharply upward-sloping EMA. Because we rely on the weight of a broader trend, this strategy is most structurally sound on macro timeframes. Sticking to the daily or 4-hour charts gives the market enough volume to respect the boundaries. A coiled spring doesn't do much good if it's trapped in a closed box. It requires the clear, open path of a larger macro trend to release its full kinetic energy. This chart shows the entry protocol. To avoid guessing the direction, skip the market orders and set pending buy stop and sell stop orders exactly 1 to 2 pips outside the absolute extremes of the mother bar. Placing orders outside the boundaries forces the market to prove its momentum before you risk capital. For risk management, choose an aggressive stop tightly behind the inside bar for larger leverage, or a conservative stop behind the mother bar for more room. Relying on precise mechanical entry rules removes human emotion from the equation. It turns a volatile breakout into a strictly calculated probability. But the market has a habit of laying traps. Sometimes the breakout triggers your entry, only to violently reverse and collapse in the opposite direction. This trap is called the fakie pattern. This is an institutional manipulation tactic. Large banks need massive amounts of liquidity to fill their heavy orders. They intentionally push the price just past the mother bar, hunting for those retail stop losses clustered on the other side. This chart shows how to exploit that trap. When initial breakout buyers are caught offside, they are forced to sell. This panic selling creates massive reverse momentum, allowing you to ride the downward wave as price crashes back through the pattern. To find the optimal conditions for these setups, you can use FXNX's NX1 platform. Their built-in volatility heat maps instantly scan the market, identifying exactly which currency pairs are currently entering a compression phase. Professional trading involves the discipline to wait through the silence. It means catching the release of the spring, but also recognizing when a trap is snapping shut on the rest of the market.